It is Friday, June 26th. Thanks for coming to visit us today. We will not be here next week. It's a holiday. The stock market will be closed on Friday. We will be in the office, kind of a skeleton crew, but we will be here if you need us. This broadcast will start again 2 weeks from today, same time, 8 o'clock Central. So the first thing I want to talk about today, this morning, we've got a couple of things we want to address. Our concept in this program was to do market insights, some of the things we look at, not just as far as what's going on in the market, but what we also want to touch on is why we do some of the things we do in portfolios. I hate to start with the COVID chart because I hope by now we wouldn't be doing it, but we are going to go ahead and have to talk about the Dow Jones as it relates to COVID. So Mallory, if you put that first chart up. And what's bothering me a little bit is yesterday we hit a record COVID. We have 37,000 cases yesterday, most of them focused in 3 states, Texas, California, and Florida. You recall when we first started a couple weeks back, I mentioned the different types of recovery we could see. And one of them was a W. And Lexi and I had been really fortunate to sit in on a Ben Bernanke conference call. And he talked about the recovery being in the shape of a W. And there was some debate going along. And we talked about, would it be a Nike swoosh? Would it be a V? What kind of recovery would it be? And what we're starting to see is Ben Bernanke's a wise man. So if you look over here on the far right-hand side, you can see that the daily movement, which is red, and then the yellow line is actually the 14-day moving average, which is more relevant. It kind of spreads things out. But you can see right here at the end, they've started to dip down again. And this is related to the Dow Jones Industrial Average, not COVID cases. So it's something to watch because there is some relationship between COVID, how it's spreading, how people are reacting, and the Dow Jones market. You can see back here when it first started was in early February. This is March 24th right here. And we've had a pretty solid recovery up until, here we go, about 2 weeks ago. And now we're starting to see this dip down. So the next week or so are going to be really interesting. We need to be careful on where we're going and see if we're going to see this W trail back down and then it'll come back up again. And I had said early on, I thought that if we saw W, we'd see that second decline start in July. That's in a week. And then I also said I thought we might see it in October. So this may be an interesting recovery cycle if we don't get this contained, come up with some kind of vaccine and try and do it. We are going to be in some kind of cycle. It's a matter of how long that cycle will last. One of the things I wanted to look at today was the world markets. And so on this chart, which we showed you last week, this is the close yesterday. And you can see I've included some of the major indices on the left. And the bottom 3 are the ones that we look at here in the US. The Dow Jones Industrial Average, which is 30 stocks, NASDAQ, which is very high in technology, and the S&P 500, which is 500 of the US companies on the exchange. Over on the right-hand side, I've added the bars that show red and green. And all that does is indicate to us what they've done since last week. So since 7 days performance, there's only been 2 spots that have gone up. One is the Hong Kong and the other one is NASDAQ. NASDAQ, I would expect, it's tech, it's high tech, information technology. That is an area where you would expect to grow because of what we're going through, the COVID. And then most of the rest of Europe, Asia, those are still going down. And the thing that was important that I pointed out last week, and I'll reiterate it again this week, is our indices are some of the most solid in the world. So while if you look over in that line on March 11th right here, we were pretty consistent with the world. We were right in the average. And over here right now, we actually have the Dow at minus 9.8, and that's still beating the UK, Hong Kong, Singapore, Australia, Belgium, which is a major market. And then the US, the NASDAQ index, is beating everybody, but again, that's high tech. And then our S&P 500, which is a really good cross section, is actually doing better than any of the world markets. So this is all really pretty good news for us, but we still have to remember that we have a world market to deal with. This is a global economy, and what we kind of see some days is I'll look and see what the Nikkei Open is before I go to bed, and then I can kind of watch what's going to happen. And then when I get up early in the morning, I can see what they did. And sometimes that's a precursor to what we're going to do. So the world markets are important to us. And when we're looking at portfolios, we're looking at designing, we're looking at what we want to do to invest, we take all that in consideration. The other part that I wanted to address, we got a question this week about asset allocation, and that's the next chart. So when we do asset allocation, it tells us we decide in interviews with our clients, discussions with you, are you going to be fixed income, income and growth, moderate, balanced growth and income growth, or aggressive growth? And those are basically ordered by risk, the least risky being fixed income at the top, the most risky being aggressive growth down at the bottom. Most folks, it's going to be like a bell curve, are going to fall in the moderate and balanced area. But what I wanted to show is we have three asset classes: cash, equities, and fixed income. And I want to talk about equities as a good example. So our target on equities is in a fixed income portfolio. We don't have any. We have actually zero exposure to mutual funds, stocks, ETFs. Let's look at moderate. We have about 30% as our ideal number. That's called our target. But the range is from 20 to 40%. So as a portfolio moves along, it kind of has ebbs, tides, flows. You're going to see it go up and down. So we want to see that still between 20 and 40 on equity holdings, and our target is to have it at 30. In a perfect situation when we set it up, it's going to have 10% cash, 30% equities, and 60% fixed income. So what happens in a market like now, you see this nice range, and then Mallory, if you go to the next one, please. What we may consider doing is kind of tightening the range. So this is, if you look at the bottom, it shows the strategies down here: income, moderate, balanced, and then this is percentage of equities. So the blue is, this is the range we're going to be. Well, what we may do, and we may look at doing that in July after the mid-year numbers are in, and then Mallory, go to the next one, you'll see us tightening this a little bit. So instead of having that 20 to 40 range being acceptable, we may bring that down a little bit and say, we're really not going to allow a tolerance outside, say 25 to 35. We really want it to be tighter. If we go outside of that in a declining market, that actually increases risk. And so you may see us doing that in a portfolio where we kind of bring those numbers in closer. Our targets are probably going to stay the same, but our variance is going to shrink. And then as the market starts going down, and Mallory, I'm going to apologize. I'm asking you to go back to the COVID chart, if you would. As we start reaching this area down here, you will see us start quietly, softly, gently widening that a little bit. And to where, while we know we can't time the market, when we see a decline going like this, we're going to tighten our range. And when we get down here and we start seeing that we've had a good run, we've dropped a little bit, we don't know how far we're going to go, but you're going to see us kind of broaden the equities range, and we may increase our exposures. And the reason we're doing that is we know that somewhere along the line, we're going to see this rise. So we're going to tighten our holding on equities going down, and then we'll start widening a little bit going up. Is it going to be a lot? Probably not. It's going to be relative to clients' age, relative to clients' risk tolerance, relative to their time horizon. But that's how we do our strategies and our models, and that's how we do all individual portfolios. So as June 30th comes, which is next Tuesday, on Wednesday morning, we're going to start seeing financials come in. We're going to start seeing quarterly reports come in. And while we always monitor what we're holding, we actually have an Excel program we wrote where we can open up every day and squares based on different factors light up red if it's something out of our parameters. So we'll do that, but at the end of the mid-year point, we'll start looking at it a little bit closer, and we'll start doing some modifications of those holdings. So that's kind of a broad look at what we're doing. So now the mid-year number, what's coming up? June 30th is coming. We'll see a lot of, we'll see some earnings being reported. We'll see some changes being made. What are we looking at? Well, interestingly enough, today we're going to be watching a little sector on groceries. It's consumer staples, but Albertsons, which is a pretty large grocery interest in the West, has an IPO that's going to hit the market. Right now it's priced at $16. It'll start trading in about 20 minutes. So we're going to be watching Albertsons to see how that does. Albertsons has been trying for about 3 years to get into the market. This is their third attempt at an IPO. It appears this is going to work. They've adjusted their IPO price down a couple of times over the last 10 days. It's going to be something to keep our eye on because it is consumer staples. They are subject to disposable income. but at the same time, they have something that everybody needs. And they are, while most of us probably haven't heard of Albertsons in the West, they're a very big grocery chain. So we'll be watching Albertsons specifically, but in general, we'll also be watching Kroger and a lot of that industry to see how they do today and how Albertsons affects it. The other thing that we'll be watching is a group of financials. And part of the reason we're watching that is because they are the ones sponsoring the Albertsons IPO. So we'll be watching Bank of America, Goldman, JP Morgan, and Citibank, Citigroup. They'll all be something that we're keeping our eye on to see how they do and see how we go through the day. So right now, it looks to be a pretty flat opening. We've had a pretty rough week. We had a pretty rough day in there. Yesterday, we did okay. But we'll be watching the opening, which right now looks to be flat, maybe 40, 50 points at the opening, which is insignificant, and see how we do. And then, of course, we're leading up to next week should be quiet. And then we'll have the 4th of July holiday on 1 week from today on the 3rd. And then we'll start seeing some of those earnings reports. And here's why that's interesting. The earnings reports we're going to start seeing include 1 full quarter of the COVID crisis, whereas the first quarter only included about 6 weeks because the crisis didn't start until really the end of February. So this report will include, it will all be affected by COVID. We know that some companies are already reporting some disappointment. Nike, for one, came out last night and they really missed their target. That's not unexpected. A lot of stores were closed. There were some things that weren't available. So that wasn't a big surprise. It's just a matter of now over the next couple of days, over the next 10 days, 12 days, keeping a watch on who is meeting target, how much they're missing by, how much they're overstepping by, and what industries those are in. And that's how we'll go back to modifying our asset allocation that we talked about a few minutes ago. So as far as where we are right now, we're not panicking at all. We look at the 37,000 cases reported yesterday. That was a record. It's disappointing because Europe has dropped down to about 4,000 cases a day. They were at 20,000. They dropped to 4. Instead, we've increased. However, a significant percentage of that was 3 states: Florida, Texas, California. California had one day this week with 7,500 cases alone. So it's an anomaly. It's not great news, but we want to keep all that in perspective. That's where we are for this week. If you have any questions, send them in. You can do a couple of options. You can address it on Facebook. You can send me an email, mmccauley@firstoptionbank.com. That's all one word, firstoptionbank.com. Or you can do Mallory Vaughn, MVAUGHAN @firstoptionbank. We'll get the question, we'll take a look at it, and we'll try and address it next week. If you have anything personally you want to talk to me about, individual stocks, give me a call here at the office, 913-259-2110. We are going to start doing a little bit of traveling to clients who are shut-ins, probably the week of July 10th. We haven't been able to see them in a while, and we care about them a lot. We want to make sure we touch bases with them. So once again, we're really happy you've joined us. See you again in 2 weeks. Have a great week and stay safe. Thanks for coming.